Real estate investors love depreciation until they sell the property. And that's because of depreciation recapture. Because when you sell that property, the IRS wants something back. Today, I'm going to break down what depreciation recapture actually is, why it surprises a lot of investors, and how it affects the taxes you pay when you sell the property. Hi, I'm Sherry Allen, CPA and tax advisor, and I help real estate investors legally pay little to no taxes using my zero tax blueprint. So let's start with the basics. Depreciation is simply a tax rule that allows you to recover the cost of your property over a period of time. Instead of deducting the full purchase price all at once, the IRS spreads that deduction over the property's useful life. For example, residential real estate is depreciated over 27 and a half years. So if you buy a rental property with $400,000 of depreciable basis, you might deduct roughly $14,500 per year. And that deduction reduces your taxable income, which means you might have positive cash flow, but little or no taxable income. And that's why depreciation is one of the most powerful tools and benefits of real estate investing. But there is a catch. Before we talk about recapture, let's revisit what basis is. Your cost basis is typically the price you pay for the property plus certain acquisition costs. Think of it like this: your purchase price plus your closing costs and certain capitalized expenses, that equals your cost basis. But over time, that basis changes. Your adjusted basis goes down as you take depreciation deductions. For example, say you have your property that you purchased at $400,000, and then you've taken $150,000 of depreciation. Your adjusted basis is now $250,000. And this number becomes very important when you sell the property. Now, let's say that you sell the property and your sales price is $500,000. You have realtor commissions of $20,000, so your net proceeds equals $480,000. Now, remember that your adjusted basis was $250,000. So your gain is $480,000 minus $250,000 equals $230,000 gain. And most people assume that gain is taxed entirely at long-term capital gains rates. But that's not how it works, because part of that gain is actually depreciation recapture. A simple way to think about depreciation is this. It's like an interest-free loan from the IRS. You get tax deductions today, but when you sell the property, the IRS wants to recapture that depreciation. And then the recaptured depreciation is typically taxed differently than capital gains. For most real estate investors, depreciation recapture is taxed at 25%. The remaining may qualify for the capital gains rate. So going back to our example, our total gain was $230,000. If $150,000 of depreciation was taken, then up to $150,000 of that gain could be subject to the recapture tax of 25%. And then the remaining gain would be taxed at the capital gains rates. This is why depreciation recapture can create a surprisingly large tax bill when you sell the property. Now, the tax code actually breaks recapture into a few categories, but there are two that most investors are going to run into the most. The first one is called Section 1245 property, and this usually includes equipment, appliances, and personal property. For these assets, all prior depreciation is recaptured at ordinary income rates, so it's fully recaptured. Next, you have Section 1250 property, and this typically includes real estate and building components. For real estate investors, this is the category that you deal with the most. Instead of full ordinary income treatment, this type usually becomes unrecaptured Section 1250 gain, and it is taxed at a maximum of 25%. This is still higher than your capital gains tax rates, typically, but lower than ordinary income. Now, here's where strategy comes in. Many investors use cost segregation reports to accelerate depreciation, and this breaks down those parts of that building into 5-year, 7-year, and 15-year property, which creates larger deductions upfront. But those deductions might also trigger a larger depreciation recapture later, which is why tax planning matters. Because you want to understand, are you creating tax savings or simply deferring taxes to a later time? Now, let's talk about strategies to manage that recapture. Now, the goal is not to avoid depreciation. As we've covered before, depreciation is not optional. depreciation is extremely powerful. But the key to planning is the exit. So here are some common strategies. Number one is 1031 exchanges. Instead of selling and paying tax immediately, you can exchange that property into other investment property. That defers both capital gains and depreciation recapture. The next strategy is just holding the property long term. Many investors either just continually hold that property or continue exchanging properties until death. Because at death, heirs get that property at fair market value, and this eliminates any of that deferred gain. Then we have strategic portfolio planning. This is understanding which properties to sell, when to sell, and how depreciation affects that. This is where tax planning becomes extremely valuable. Here is the big takeaway. Depreciation is one of the most powerful tools in real estate tax strategy, but it's not free money. Eventually, the IRS may want to recapture that depreciation when you sell your property. Understanding how this works allows you to plan exits more strategically, use tools like the 1031 exchange, and avoid getting surprised by a tax bill. Because in tax planning, it's not just about saving taxes today. You have to think about what happens later too. To see if you are a good candidate for my zero tax blueprint, check out the link below and complete a short survey to get your zero tax readiness profile.